Welcome to our video on single fund portfolios, a topic often debated among young investors. Investing your retirement savings can indeed feel daunting, and many young investors wonder about the optimal strategy, especially when concentrating their assets in a single fund, like the popular FXAIX Schwab S&P 500 Index Fund. This video explores the risks and rewards of this approach and offers valuable insights for those starting their investment journey. Before we dive into the details, let's outline the areas we'll cover in today's video. First, we'll explore what a single fund portfolio entails. Following that, we'll discuss the inherent risks, such as lack of diversification. Then, we'll move on to the advantages, including simplicity and low costs. Next, we'll explore alternative strategies for young investors. Finally, we'll wrap up with recommendations and summarize the key takeaways. We'll begin by exploring the risks associated with concentrating all your investments in a single fund, even one tracking a major index like the S&P 500. A single fund portfolio is heavily weighted towards large U.S. companies, which means it neglects other sectors, asset classes such as bonds and real estate, and international markets. This lack of diversification increases the impact of market fluctuations and specific sector downturns. While the S&P 500 has historically performed well, it's not immune to significant drops, and any such drop would affect your entire portfolio. This concentration of risk may be unacceptable depending on your risk tolerance and time horizon. Let's test your understanding so far with a quick quiz. What is a major risk of a single fund portfolio? Is it higher expenses, lack of diversification, too many asset classes, or involvement in international markets? You may pause the video now to think about the answer. A while. We will discuss the answer in the next section of the video. The correct answer is the lack of diversification. A single fund portfolio concentrates risk, increasing vulnerability to market fluctuations and specific sector downturns. Despite its risks, a single fund approach offers advantages. Simplicity is a major appeal, as managing one fund requires minimal time and effort, ideal for those preferring a hands-off approach. Additionally, the expenses are minimized, since single funds generally have low expense ratios compared to actively managed funds or multi-fund portfolios. For younger investors with a long time horizon, the benefits of dollar-cost averaging and potential for long-term growth through a well-performing index like the S&P 500 can be substantial. For better diversification, several alternatives can be explored. Firstly, a three-fund portfolio offers broader diversification by combining a total U.S. stock market fund, an international stock market fund, and a bond fund. Alternatively, target date funds offer a pre-built, diversified portfolio that automatically adjusts based on your retirement timeline, handling the asset allocation for you. Remember to check the expense ratios, as index-based TDFs generally offer lower fees. For young investors with a long time horizon, some risk is acceptable. However, it's advisable not to put all your eggs in one basket. While the S&P 500 has generated significant returns historically, complete reliance is inherently risky. Therefore, consider your individual circumstances, risk tolerance, and retirement goals before deciding. If you are unsure about your risk tolerance, consult a qualified financial advisor. While a single fund approach has benefits, incorporating a broader level of diversification can potentially safeguard your retirement savings from significant market downturns. In conclusion, the decision of whether a single fund portfolio is too risky depends on several factors, including your age, risk tolerance, and investment goals. A longer investment horizon generally allows for greater risk tolerance. If you are investing in a tax-advantaged retirement account such as a 401k or Roth IRA, a single fund approach may be manageable. Regardless of your strategy, research and planning are crucial for successful long-term investing. Consider your options carefully before making any investment decisions. Thank you for joining us on this investment exploration. If you found value in this video, don't forget to like, share, and subscribe. Let us know your thoughts in the comments below. We love hearing from you, and it helps us bring more valuable content to you. Happy investing!